Welcome back to another episode of Gimme Some Truth. Clint and Keith and myself, Nate, are in the booth today to talk about bubbles, investment bubbles, but maybe somebody would be confused by other bubbles?
Well, I was going to say, usually this time of year, going into the holiday season, I think Clint and I have done podcasts in the past about wine. You might invite me on to talk about the other kind of bubbles.
French
champagne.
wine.
Indeed. But we're not talking about that kind of bubble. We're talking about the investment financial bubble. And you guys have probably experienced, like I have, people talking to you, asking you questions. Are we in a bubble? Is AI a bubble? That sort of thing.
Yeah, it's interesting because we hear this phrase, this idea, not all the time in our world. We hear it in sometimes, but it feels like we're hearing it more now. You and I remember when you heard this in 08, 09, prior to that. So it's not all the time that we hear this, but when we do, it definitely stokes fear.
Yeah, and I think that also when you talk about bubbles, it's usually posthumous. It's like, okay, I got
absolutely.
a situation where it happens and, oh yeah, we were in this bubble, this sort of asset inflated situation, and everybody could see it after the fact. And no one could see it when they're in the middle of it. And I think that's a lot of the point of bubbles is that, and that's the reason maybe why we are not in a bubble right now, is that everyone's talking about it. We might be. It's usually when we're all feeling like we're just full steam ahead and nothing can stop this rally. And that's when we actually see the bubble. But when it bursts, then everyone's the money quarterback on it.
Or said another way, how many bubbles, quote, bubbles have we been in that didn't pop in the last, say, 15 years? You could make an argument that conversation kind of got some momentum behind it, and then ultimately never happened, never actually burst. But Keith, why are people asking this question now?
Well, I think, there are two factors. One is the valuation factor. When you look at where stacks are trading now, the P/E ratios, the kind of fundamental price earnings, how many multiples of their earnings are a stock trading at, are very, very high, both in their annual terms, trading, I just looked at the data from JP Morgan, about 23.2 at the end of October times earnings. Usually over the last, 20, 25 years, you're looking more at 16 to 18 times.
On the
earnings.
S&P.
On the S&P,
Yep.
On average. The CAPE, which is the 10-year, it goes back times those 10 years of earnings. We're looking at 40.2, I think is the number I saw. And again, there over the last 10, 15 years, you're looking at, somewhere around 25, 28, much lower. So in terms of valuations, very, very expensive. I think there's also a big psychological component. The fancy TikTok word we might use would be FOMO. Though I was reading a quote in Panics. Let me double check the title here. Manias, Panics, and Crashes by Kindleberger and Ali Bear. And they said, there's nothing so disturbing to one's judgment as to see a friend get rich. And I think that's kind of the psychological aspect of this.
Yeah.
You hear about your friend who bought NVIDIA before everybody else did.
Yep.
We may hear it from someone we work with quite a bit, that they bought it early on and, it's now worth all this value. We're also seeing it maybe with Bitcoin, that sort of thing.
Yep.
It's gone way up. So that's the psychological pressure. Am I missing out on something?
And the inherent nature of that makes the bubble bigger
Yep.
and bigger because then it's piling on and piling in that.
Oh, he got rich on it. Why am I not?
Clint, if we're in high valuations, which we all know we are, does that necessarily mean there's a bubble? Is there a way, said another way, is there a way that we can work our way out of high valuations that does not involve a bubble bursting?
Yeah, I mean, you can have many cases the bubble deflate a little bit where you see a correction, and then that sort of wall of worry helps the stocks.
Sure.
We've seen those little mini pullbacks over the course of the year. Even earlier this year, if we think about where the NASDAQ was, the NASDAQ was down significantly throughout this year and then recovered. So, there are situations where you can see it kind of battered back. But I think more importantly, what you need to see is increasingly good earnings. And so in the beginning of the year, I always mention to clients like, hey, in order for us to get to higher stock prices here, we need record earnings. And the earnings have been very strong. So that has supported some of that. Now we've gotten even higher valued too. So, I would go back, do we need record earnings? Because, it is looking pretty overvalued if we look at metrics in there too. So, I mean, a lot is going to have to happen with corporate earnings to be able to drive those stock prices higher from here.
Yeah.
I would just add the one other thing too that's in play that the markets have been taking into account is lowering the risk-free rate of return, right? If the Fed keeps cutting rates, because then, instead of getting guaranteed 4% to keep money in a bond, you're only getting 3%. Money will move and will support higher multiples if you're looking at discounted future cash flows and whatnot.
Yeah, one of the things that I always find interesting about this is, you can track a lot of these ideas back, 50 years, 100 years, some cases 150 years. I mean, we can go back 400 years to locate 450 years, right? To locate kind of the first, if you will, bubble that at least that we're aware of in the Netherlands.
Yeah. And so that's kind of my motivation for this podcast was we've been hearing about bubbles from our clients. And so I wanted to go back and look about Tulip Mania, which is kind of the original, the bubble, if you will, the one everybody talks about. And generally historians, so the tulip was discovered, brought to Europe from kind of the Near East, Middle East in the 1590s. So it had been around for a while. And there were all sorts of, kind of cool stuff about it. But the bubble started, coming in, most people think like 1634 to 1637. So it lasted for a while. It isn't, just, although some research has said it lasted even less. But you saw at one point, a point where you could buy a tulip for the price of a house, in the Netherlands. And that seems crazy. But one of the things I think that happens in bubbles is you have a new technology. And you don't know how to value that technology and so on. And so a couple of things were new technology around tulips. First of all, the tulip itself, relatively new plant. The second thing was they developed, and the Netherlands was the richest country in the world at this point. They developed new breeds. There were trading, and this was also the age, kind of the beginning of collecting. So natural history, you may have heard of like a cabinet of curiosities. And so people were collecting stuff from all over the world, the natural world. Shells went up in value as well because they were discovering exotic shells from all over the world. So you had this new technology. Up until this point, gardens weren't for display. And now all of a sudden you had gardens as display objects, beautifying. And so that changed things. Then there was also kind of a cool thing in the Dutch tulip market that there was a disease that would strike certain tulips that would make them have like striations, you could say, like waves of color, red and white in a single. They didn't know what caused them. And so you could put a tulip in the ground, and then a year later, because it had gotten this disease, it could be this totally cool looking different thing, this different object. All of a sudden way more valuable because it was super rare, right? Yeah. And so that added a little bit of speculation to it. And the cool thing about the tulips was it was a futures market.
Yeah.
A lot of the money traded hands in the winter. You couldn't move them when they were blooming, and then you had to actually lift them out of the ground and take them out to preserve them in the summer months. And that's when they moved. But a lot of the trading happened in December, January, February. And so between like December of 1636, not 1936, and kind of February, you saw prices triple in that little bit. And then everything kind of went to hell. And the longstanding rumor has always been, it bankrupted people. There was all this. But in fact, it was mostly like kind of rich people investing, and nobody went bankrupt due to tulips, the research has suggested. Nobody threw themselves in canals because their tulip bets went wrong. But, it did burst. I would think of it like, during COVID, people were sitting around and flipping like watches or various things like that. I think of it a lot like that, right? Yeah, I think ultimately it became more of a cautionary tale than anything, but an incredibly powerful and incredibly kind of useful cautionary tale up to the late 1990s.
Yeah, and I mean the 90s I think is the classic bubble that many people have actually experienced. I remember opening an account with a buddy of mine. We had a joint account. We went into the Scottrade office at the time, and we bought our first stock, which was Netscape. And then we parlayed that win and it was a big win for us. And then we parlayed that into Massimo and just lost terribly. It was awful. We tried to double and triple down, and it never panned out for us. But that was in the middle of the kind of the internet bubble that got created. And so, as Keith was alluding to, he's absolutely right about this new technology that was game changing, this thing called the internet. And it was going to change everything, how we did commerce, how we lived our life, how we were going to obtain our groceries and our pet supplies and all of this. And you know what? In the end, it did.
It did.
Yeah.
Right.
But it didn't for a while, you know?
Yeah.
So, there was a situation where the famous bankruptcies of pets.com, a local company here, Sonic Foundry. If you ever want to see a fun chart, look at Sonic Foundry, SOFO, where it was just like straight up and into the stratosphere, no earnings, no nothing. And it became this incredibly valued company that was so overvalued. It was ridiculous now that you look at it now, and now it's just worth pennies. I mean, there's a story after story of this giant internet bubble that anything with the .com on it exploding in valuation literally overnight. People were changing their company names just to have .com in there. Maybe we're seeing the same thing with people doing .ai after it. But classic internet bubble, and then it burst, and it actually took 3 years. And part of it was 9/11 in there too. There were some extra shocks in there too. But it was kind of a painful deflation of that giant bubble.
Yeah.
I mean, I was just going to say, looking back at the companies that made it, and this is where the long shot comes in it. But you had no idea how to value any of those companies because they were going to change the world, right? Everything was going to be different. How we were doing things was totally going to change, and in a lot of ways it has, right? And so, but you didn't know how to value it. It's similar to, the tulips in some sense. You didn't know. And then the other thing was everything just kept going up, and you were an idiot for not buying .com. If you started talking about price earnings ratios in the late 90s, people looked at you like, oh, who pulled away the punch bowl?
Well, you looked stodgy, right? It looked like you were kind of almost misinformed of this kind of old way of valuing a company, and so, and you're right, Amazon and eBay, still, incredibly thriving companies today came out of that period of time. A lot of them, pets.com, didn't, right? And I think at the end of the day, it's as the phrase has been coined, irrational exuberance, right?
Yeah. No, that was the big, and again, you speak of people looking kind of stodgy, right? That was Greenspan's view on kind of, and this was as early as like 1996.
Yeah.
And so the exuberance continued for 3 or 4 years after that, right? And he was looking at, this technology can't change that much. And, Alan Greenspan had cut his teeth in an earlier bubble, right? In terms of, there was a similar craze in the 1960s where companies were adding tronics to their name because anything electronics, right? The evolution of the computer was the 1960s. Again, a technology people didn't know how to value. And you saw, stocks go up, and people didn't care how much they paid for these companies. And, you saw a downturn from that, right? So I think, he had seen it and went, step back. And so I think it becomes, that we move away from valuations and becomes, as you had alluded to earlier, are we in a bubble because everybody is cautious about it? I think also the way people invest is radically changed in those, we're no longer, most people aren't just looking for a single winner.
Right.
It's a diversified portfolio. They're in their 401k, so they have, funds and so on and so forth. So it's changed a little bit, but yeah. So I think that might, slow down the bubble because I don't think we've seen yet people going, you're not talking to your cab driver in Vegas about how he's flipping 3 condos.
Right.
Right.
Let's wrap it up with this. Clint, you were through the .com. You and I also were through the 08-09 crisis. Help people to understand how this feels similar. Help people to understand how today feels different than those times.
Yeah, I think there's unfortunately a fair amount of similarities between those. I mean, I think that people are not unfounded when they say that they feel like we might be in a bubble. It has a lot of bubble properties. So I can definitely understand a client saying to us, yeah, this feels bubbly. Real estate market too, remember too, like that felt very bubbly for a while too. And people were saying, there were people that were saying this can't persist. These real estate prices can't stay this high this long. And I think there are a lot of different places that you can look at overvaluations. It's not solely stocks. We have cryptocurrencies that are at incredibly high levels, and we don't even know what the valuations of those are.
I think that's part of the trouble too. We don't know how to value those things, right?
Very difficult.
Yeah, you don't have a company you can value based on earnings, right? We knew with .com, it was like, is this company going to make money ever? Is it not? With crypto, you have no way of knowing, right?
Right. And that was technology that is going to change the world. And I really do believe that the technology will change the world, but how it looks will likely be markedly different 5 to 10 years from now than what we thought cryptocurrency was going to be. We originally thought that crypto was going to be Bitcoin. It's going to be so much more than that, and it's so much more varied and nuanced than that. So when we talk about bubbles, coming back to that, we're in this enormous AI run-up of investment. And one thing that strikes me as interesting is that we don't have that many publicly traded companies, where that kind of varies a little bit. And maybe this changed over the next few years as we're kind of running up to that. There were a whole bunch of companies that became public and then kind of lit fire on the whole big bubble. I don't think we've gotten there yet.
Yeah.
I think we need to see a rush of IPOs. And at that point would be the point that I would get more and more concerned about this. I do believe that AI will change our lives for the better. I think that AI is the most exciting technology since the internet. I also believe that these companies are not dumb. You have incredibly cautious and well thought out theses for why these companies are making these deep investments into this technology. So I think there is something there. It's just a matter of how long it takes. The greatest concern that I have is, are investors going to have the appetite to stick through the moments where we have these AI pullbacks? Yeah. And so I think those are likely coming. I just don't know if we can. I don't think that you can time those out. So you have to be kind of like, I'm going to hold and I'm going to, do well through this and diversify, and I'm just going to see it on the other side, and it might take me 10 years. Or you got to just be mindful of the fact that you might not be able to take that mentally, and you should reposition your portfolio to perhaps not get all the upside, but protect a little bit better on the downside in a market that appears to be overvalued.
Yeah, you're not going to see us predict whether we're in a bubble. I think that's frivolous. I think that's trying to predict, what the world's going to look like in a year, which is almost impossible. I think what you are going to hopefully take from this podcast is that, valuations are high right now. Doesn't mean they can't go higher. Doesn't mean that, as Clint said earlier, that we can't have a little air let out of the bubble along the way, and it can, the bull market can persist. But what we are saying is that, there are indications that, things are getting a little frothy. The FOMO, fear of missing out, is definitely real. And I think the most important thing is right now to understand, what is your risk level? What is your allocation? Do you know how your portfolio is built right now? Do you know when the last time you were rebalanced? These are all really, really important things as we get into these kind of frothier times in the market. So we hope you found this valuable. If you want to have us talk about other topics along this line, we definitely will do so. Let us know. But otherwise, we look forward to seeing you.
South Sea Company, we skipped over that.
The South Sea Trading Company.
Yeah.
The number of bubbles that are out there are it's not without history, right?
Yeah.
And so we can look at those, and we can hopefully learn something from those. We'll see where it goes from here.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit walknercondon.com.